Good afternoon and welcome to the EVOKE PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time via the Q&A tab situated in the right corner of the screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you up to CEO Per Widders-from. Good afternoon to you, sir.
Thank you so much, and good afternoon, everyone. And thanks for joining us today for our H1 2025 results. I am Per Widerström, and I'm joined today by Sean Wilkins, our CFO. On slide 2, you can see the running order for today's presentation. I will kick off on slide 3 with some key highlights for the first quarter. Firstly, having returned the business to growth last year, this has continued with our fourth quarter in a row of growth. We saw improving trends through the half with Q2 growth of 5%. This is being driven by continued very strong performance in our international core markets and retail returning to growth. Secondly, we have significantly enhanced the profitability of the business. This is through direct actions like operating model changes and associated cost reductions, as well as driving operating leverage by growing the top line and being more effective and efficient with our bonusing and marketing, improving margins. As I've said before, we are executing both a short-term turnaround while investing in building out our longer-term capabilities. The strategy is working and we are pleased with our progress, but we know there's a lot more to do. We're excited about H2 and remain laser-focused on execution as we strive to deliver our value creation plan. Sean will now cover the financial results.
Thanks, Per, and good afternoon, everyone. I'm delighted to be reporting a strong set of numbers for the first half, which deliver on exactly what we said we would do. On slide 5, you can see that the total revenue for the half was a rather poetic £888 million, which was up 3% as reported and 4% in constant currency. On adjusted EBITDA, we delivered £166 million, which was at the higher end of the range we gave in our trading update with a fantastic 44% year over year. In UK Online, we saw revenue down 1% for the half, with Q2 showing sequential improvement in both absolute terms and growth rate, but still only flat. Per will talk through in more detail, but one of the reasons for the lower revenue growth is our evolving marketing approach, particularly on the 888 brand. Adjusted EBITDA was up 16 million or 37% year over year. In retail, the business returned to growth for Q2, which was the first quarter with all our new gaming machines rolled out. However, for the half as a whole, it was down 2%, driven by sports, which is primarily affected by market-wide issues such as the racing industry being under pressure and wider high street footfall dynamics, as well as lapping the Euros last year. We're addressing some competitive gaps in half 2, which along with the good performance of the gaming machines is driving our confidence in the second half. On EBITDA, we saw the impact of negative operational leverage for the half, along with higher fixed costs from national insurance and national living wage changes, which offset savings that we'd made. The international segment continues to perform really strongly with revenue growth of 13%, driving excellent operating leverage, which has been helped by structural cost reductions and more efficient bonusing and marketing. As a result, EBITDA more than doubled to £86 million and made up over half of the overall group EBITDA for the half, highlighting the group's improved diversification. Central costs increased slightly, with most of the cost reductions landing in the divisions, meaning inflation and investment in capabilities added a little bit to costs here. Turning to slide 6, these charts focus on our adjusted EBITDA development. On the left-hand side, the bridge walks through how we went from 115 million EBITDA in half 1 last year to 166 million in half 1 this year. You can see the key movements here being the revenue growth, but also the gross margin improvement. This has come from online across both UK and international and is driven by a combination of the actions we've taken in the past year or so since Per and I joined. We closed US B2C. This means savings on market access and other fees that went through cost of sales. We've migrated more of the business onto the in-house platform, including Mr. Green in all international markets, as well as utilising more of the in-house sports trading platform. These are driving revenue share savings from removing third parties. And crucially, we have talked about before, we have really optimised our use of bonuses and free bets. Marketing was 12 million lower year on year, and we drove 4% revenue growth despite this, evidencing better returns we're getting. And finally, our cost base is 4 million lower year on year, despite NIC and living wage headwinds, along with underlying inflation. This is due to the direct actions we have taken to take out cost from the business. On the right-hand side, we show a similar bridge to what we had at this point last year, walking through how we go from 166 million we delivered in half one to what we need to deliver to meet our guidance for the year, which remains unchanged. As you can see on the bridge, the main driver of the half and half improvement is the operating leverage we will get from the revenue growth, which will deliver an additional 40 to 50 million pounds worth of EBITDA. Turning to slide 7 and our cash flow. This is our usual bridge, taking you from opening to closing cash, excluding customer balances. Just a few things worth calling out here. On tax, we received a tax refund earlier in the year, and you'll recall at full year results, I'd said this was why we didn't expect much cash tax for the year as a whole. On working capital, we expect this to be positive for the year, one of the drivers being second half growth I just discussed. Exceptional costs for the half of 13 million are in line with our plans. Interest was in line with 175 to 180 million guidance of the year as a whole. We repaid 14 million of the RCF during the first half, and other represents the ongoing amortization of the dollar term loan, as well as some additional funding for 888 Africa and a 9 million translation effect from movements in foreign exchange. You can see on the top right table how the growth in LTM EBITDA has delivered significant deleveraging in the period. We remain confident in our ability to drive strong future cash generation and hit our fiscal 27 target of less than 3.5 times leverage. Turning to slide 8, some comments on current trading and outlook. July is always a quiet month, and we're lapping the Euros, so it's difficult to extrapolate anything from that. We have seen a good pickup in August as the football returns, and with the Premier League starting this coming weekend, we're seeing really strong engagement on our new free-to-play game. Underpinned by the continued growth in gaming, retail cabinets performing as planned, and a strong product pipeline for the second half, I remain highly confident that we can achieve our plans, and our guidance for the year is unchanged. With that, I'll hand back to Per.
Thanks a lot for that, Sean. So turning to slide 10 with a quick reminder of the value creation plan and the strategy. We have already completely transformed this business, and it's a total reset. It's clear to me that the strategy is working and the financial performance has started to show this. We are truly committed to driving value for our shareholders. Turning to slide 11, I'm delighted that we delivered the fourth quarter of growth with Q2 at 5%. Delivering growth while simultaneously taking significant costs out of the business and transforming the ways of working is not easy. So I'm pleased that performance is improving across all the divisions. H1 also showed clear evidence of the step change in profitability, with LTM EBITDA now at 363 million pounds. And we are laser focused on driving further operating leverage going forward. We have also significantly reduced leverage over the last 12 months by 1.7 times to now sit at 5 times, driven by the EBITDA growth and net debt broadly stable. This trend will continue for a little while longer while we transform the business and remain on track for our 2027 target of below 3.5 times. Turning to slide 12 and focusing on how we are driving execution. We break this down into 3 areas where we are aiming to create long-term competitive advantage, and we made good progress against each of these in a half. On our drive for operational excellence, we have made significant progress in our Operations 2.0 strategic initiative, which is all around our AI and automation efforts. In H1, we automated a lot more customer journeys to improve the experience and reduce the need for manual interventions. These benefits will compound and drive higher margins over time. On the marketing side, we are transforming our capability, including new leadership. This is an area we continue to focus on, with further improvements to come in the second half as we improve our real-time data capabilities and expand the platform integrations. In the first half, we continue to execute changes to take costs out of the business and streamline our decision-making processes. In H1, we made significant progress with the launch of the new William Hill customer value proposition. And if you use our products, you will have seen the new look and feel and color scheme. But the CVP goes far beyond simple look and feel, and impacts everything we do, from price and promotions to product and customer experience. We have also delivered a step change in our product capabilities, with much more focus on product rollouts and improvements, and ongoing focus on simplifying the UX across our products. Turning to slide 13 and retail. This was an important half for retail as we successfully complete the rollout of 5,000 new gaming machines. You can see from the chart in the middle that now we have the first full quarter of new machines, with gross win per machine per week around 15% higher than it was on the old machines. This should continue to drive growth through the second half. We are aware that we have lost a bit of ground on the sports side. This largely reflects historical underinvestment on the digital side of things. We have been addressing this through some UX improvements, and in the second half, we plan to replace a significant number of self-service betting terminals, or SSBTs, as well as adding some additional ones in select locations to close the density gap we have with some of our competitors. With the improvements we are making, we are confident that retail can continue its growth curve despite tough high street conditions. Retail profitability is down in the first half. Some of this reflects product mix, with the new cabinets driving high revenue share and duty charges, and some reflects the additional cost headwinds from national insurance and national living wage. We continue to look at the cost base where possible to drive efficiency, but the real improvements will come from top-line growth, where we can generate strong operating leverage on the fixed costs. Turning to slide 14 and UK Ireland Online. Our strategy is focused on profitable growth, and for this reason, I'm okay with the flat top-line performance in the first half. We are undergoing a transformation, and we have delivered a real step change in profitability with 37% growth in EBITDA. Structural cost reductions, an overhaul of the marketing function, the shift in strategic focus to customer value over volume, and optimization of bonuses were key factors here. You can see on the chart on the slide that revenue growth is being driven by William Hill, and particularly William Hill Vegas, which is performing really strongly. Overall for H1, William Hill was plus 3%, and 888 was minus 14%. Within this, William Hill Vegas was plus 12%. So we believe as a brand, it is clearly taking market share, and this has been supported by the relaunched app and improved CX and UX. So we have done a great job with William Hill in the UK, with the products now among the best in the market in terms of features and UX. And during the first half, we relaunched new football and horse racing pages with simpler and slicker designs. For the start of the football season, we are improving the bet builder and the cash-out offering, supported by the launch of a fantastic new free-to-play game called Final One Standing, which mirrors the popular game format of picking one team a week to win. The season hasn't started yet, but we have seen great engagement on this already and expect well over 200,000 sign-ups by kickoff. On the sports trading side of things, we have improved underlying margins through a new pricing and risk management approach. And on the gaming side, we relaunched a new William Hill Vegas app, launched Bonus Drop Boost as an exciting daily engagement feature. The reason for the revenue decline in 888 is our focus on profitable growth. You can see this on the slide with revenue down double digits, but contribution up double digits. The reality is that the returns on marketing spend for 888 simply did not stack up. And we have evolved our approach as part of the overall marketing transformation mentioned earlier. We have also recently changed the management of the brands to separate teams so that 888 can get dedicated focus that it needs to return it to profitable growth, which will be supported by the launch of a new customer value proposition later this year. Overall, we are excited for the potential of the UK business and confident in our plans to return it to profitable growth. Turning to slide 15 and the international segment. A strong first half performance for our international division and led by our core markets, which as a group are up 22% for the half in constant currency. You can see on the slide here that all markets are growing, and while Romania benefits from the acquisition of Winner, we have also seen fantastic growth in the 888 brand there. Importantly, as well as a strong revenue growth, this was delivered profitably. And you can see on the right-hand side, we are seeing fantastic growth in contribution. And as Sean said earlier, when coupled with the cost reductions, this meant EBITDA for the division more than doubled. In Italy, we are growing share led by 888 Casino, which continues to outperform local brands and even the omnichannel operators, with a strong brand and the product resonates well. In Spain, we are still growing well. We have lost a little bit of overall market share due to our sports product not being up to scratch, particularly William Hill, with the 888 brand gaining share on the gaming side. We have focused on the UK first for product improvements, but have plans in place to address some of the gaps in Spain across the second half. In Romania, we have doubled the business both through acquiring Winner, but also really strong growth in the 888 brand. The 888 players have now been migrated onto the Winner platform, and this is expected to drive further improvement in the second half. In Denmark, Mr. Green is our main brand and one of the strongest brands in the market. During Q1, it was migrated onto the 888 platform. While we saw some minor initial disruptions expected, particularly on sports, Q2 was up 26%, and the in-house platform is driving strong engagement. In the rest of the world, we continue to optimize for profitable growth with stability of revenue and higher profitability, which is enabling the core markets to drive overall growth. Finally, on slide 16, with our conclusions before taking your questions. So we continue to see the impact of the transformation and reset we have undertaken, with the business continuous growth trajectory while significantly improving profitability. As well as improving short-term trading trends, we have been investing heavily behind our strategy, focusing our resources on our core markets and investing in our long-term capabilities. The improved Q2 momentum and our strong pipeline of product improvements and operational excellence initiatives mean we are reiterating our guidance for 5 to 9% revenue growth and at least a 20% EBITDA margin in 2025, leading to material deleveraging. So with that, I'd like to say thank you for your continued support, and we're now ready to take your questions.
That's great. Well, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated on the top right corner of your screen. We have received a number of questions, so I'll start the Q&A session off with the first question here, which reads as follows. Do you have any expectancy of paying a dividend? And if so, when do you expect that will be?
Yeah, thanks for that one. The financial policy of the business is to pay dividend at below 3 times leverage. And we've set out that our plan is to reduce leverage to 3.5 times by the end of 27. So not in the foreseeable future, no.
That's great. Thank you very much, Sean. The next question we have here, based on the current share price, the market does not seem to believe in the turnaround story. How do you plan to address this?
Look, my view on this is I think we're showing good progress. I think half one has been a demonstration of the progress that we've made with great profitable growth, excellent deleveraging. And so I'm reasonably pleased with the first half. How the market values the business is up to investors and what they want to buy the shares at. So, that's not something which we intentionally manage. We manage the business to the expectations that we set. And my strong expectation remains that we'll hit those into the second half and into next year.
Perfect. Thank you very much. Can you give some more detail on the recent entry to the Dutch market with Come On, and what is the revenue split?
Sure. So the second part of the question shows that you've seen what the economic deal is. It's a brand licensing deal with Come On. Come On have got several other brands there, and this is adding to their portfolio. We're quite excited about it, as we're quite excited about the brand licensing business, which is a capital light way of leveraging the brand asset worldwide where we're not currently operating. We absolutely get the opportunity to purchase that business at a specified point in the future across all of our brand licensing deals. So this doesn't exclude us from any market, and so economically, it's an excellent thing to do. In terms of revenue split, we've not shared that information.
Can you just say that in the very early days, but those early signals in terms of the market entry is very positive.
Perfect. Another question here, really around marketing. With marketing now product-led rather than promotion-led, have you seen any impact on customer churn rates?
Look, let me have a go. First, Per, you want to add something, then feel free. Our marketing and the efficiency and the targeting of our marketing has changed substantially since Per and I joined the business. It's much more efficient now, and it's much more effective. In terms of churn, we do see reduced churn in the targeted cohorts, so our marketing becomes even more effective as a result of that.
That's great. Turn to the next question. When do you expect to see some shareholder value being returned to shareholders, maybe in the reintroduction of dividend and an increased share price? I know you've covered some of that, but if you could add some more color, that'd be great.
I can just it was mentioned by Sean before, but being a shareholder myself, obviously, I expect substantial shareholder value creation. When it comes to EVOKE, what we are focusing on, what we can focus on, what we are absolutely adamant to deliver is, of course, the transformation turnaround, and in order to, what we said before, drive value to the shareholders. So it's back to execution. And as we talked about, the profitable growth, underlying EBITDA margin to improve, and of course, the deleveraging. So that is what we can control, and that is what we're focusing on.
Thank you very much. Are there any more plans to enter new markets, like the recent re-entry into the Netherlands?
So let me take that one. We are very happy with the focus we have when it comes to the core markets. And we will double down on those markets as part of our strategy. We have some fantastic brands in those markets, and quite a few of those markets are having high barriers to entry, so well positioned in those markets. We also have the optimized markets that we have been talking about in the presentation, that we go for, in essence, optimized and the profitable revenue and cash flow generation. When it comes to additional markets, we are always open to looking at opportunities, but once again, there's plenty of value creation opportunity in our existing markets. So that is our first, second, and third priority.
Moving on to the next question in the panel. Congratulations on a solid first half of 2025. Looking forward to seeing this continue in the second half. There's been recent commentary in the UK media about the UK government increasing gaming taxes. Does the management team have any thoughts on this, and is this factored into the medium-term plan in any way?
So a year ago, the government kicked off a consultation on duty. That's now finished, but it's not been published, and there's no news yet. And the idea was that any impact of that would come in October 27. Notwithstanding that, it's clear that the government wants to generate cash, and so we don't know is the truth. We are in a wait and see game, and anything that I say is largely either our view or speculation. Notwithstanding that, our view is that after a certain point, increasing tax will only lead to a growth in the black market and channelization into the black market. that has two detrimental effects. One is that it lowers tax revenue, and two is that it has zero player protection, which is very important to us. And this isn't just a theoretical perspective. It's very evident in the Netherlands, which is absolutely right on our doorstep. So if you want evidence of it, just look there. As a result of that, we have a fairly strong expectation that the Treasury will make a balance between raising cash and also making sure that the industry can continue with the trajectory that it's on and continue to flourish, because that's the best way to make sure that the Treasury gets the additional cash. The second point is it factored into medium-term plans. Look, because we don't know the rate, it's not, another way of seeing this is what mitigations are there across the P&L. There are ways of mitigating sensible changes to the tax rate. If you go way beyond sensible, mitigation becomes more difficult.
Okay, perfect. We have one final question in the panel. I think everything else has been covered. So if you do have a question, please do submit it now. The question is, what actions are management taking to lower the current debt?
There's only one way of reducing current debt, and that's to generate cash. We are expecting to see a small inflow of cash this year. The reason it's only a small inflow is debt servicing, but also investing in the turnaround. Next year, as a result, partly of that investment, we will see significantly improved EBITDA. And with the improved EBITDA, I don't really expect the other elements to go up very much. Perhaps some of them might even come down. And therefore, as a result, I do expect to see pretty significant cash generation next year, and that will start to eat into the debt pile.
Perfect. Well, we haven't had anything through as of yet. So, Per, I'll just ask you for a few closing comments, if that's okay, and then we'll redirect investors for their feedback.
Yes, thank you so much. So we do see, and I'm so happy to see that the strategy and transformation is working. As you have seen today, we are calling out the fourth consecutive quarter of revenue growth. We are calling out significantly improved profitability with adjusted EBITDA plus 44% year over year, and the LTM adjusted EBITDA of 363 million pounds. We just talked about the continued progress when it comes to deleveraging, which is now 1.7 times reduction year over year to 5 at the end of June this year. So we are absolutely well placed for further strong profitable growth year to go and also beyond 2025. And we are adamant that and all focused to drive shareholder value. So with that, I would like to thank all of you for attending the call and for your continued support. Thank you so much and have a great day.
That's great. Well, I'd like to thank you both for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback, and all the management team can better understand your views and expectations. On behalf of the management team of EVOKE PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.